Hey folks, Dan Frio here with your opening bell for December 10th, 2024. So mortgage rates, they increased just a little bit yesterday. What's going to happen today? Well, that's what we're going to talk about. But I'm expecting today to be kind of humdrum because tomorrow is the big day. Tomorrow is when we start getting those inflationary numbers that we're really going to pay attention to. It's more important than you guys think. So I did find an interview this morning with a young man right here from U.S. Bank. He breaks all this down, and the commentary back and forth is right on point. They're actually talking about how CPI, what the outlook is for that, the bond market, how it's going to react to the CPI numbers, because that's the biggest portion of our mortgage rates, is how the bond market reacts. And then they go on to really explain a very good detailed explanation on how inflation works. Because a lot of people think, bread prices went up, they were 99 cents, and they went up to, $1.50, and went up that much incrementally. And then, this year inflation's up another 5%. So it didn't go back down to $1 and then adjust from there. It goes from $1.50 or wherever it was, and it just keeps compounding on itself. A little bit confusing. Check out this video. They bring it a lot into context, but here's what we're looking at right now through the rest of the week. Wednesday is the CPI number. The C on the front of that means consumer inflation. On Thursday, we have the PPI. The P on the front of that, it means producer. And then we have initial jobless claims also coming in on Thursday. So this is right in the wheelhouse of the Federal Reserve. Right now, the MBS market is down 16 ticks. That means mortgage rates are going up just a little bit this morning. But I want you first to hear this interview, and then when we come back, I'm going to kind of go over the whole, what the CME FedWatch tools telling us, what the pre-equity markets are doing right now, and what the bond market's doing. So let's get over to it to see what he has to say.
The main event for the markets this week is the inflation data at the consumer level. We get the CPI report for November. It's due out tomorrow morning, and it is expected to show that inflation ticked up slightly from October. You're talking up 0.3% for the estimates on this. Last month, it was 0.2%. You're also talking year over year up by 2.7% versus up by 2.6% for the previous month. For more on this right now, we want to bring in Eric Friedman. He is Chief Investment Officer of U.S. Bank Asset Management, which has nearly 496. I think it's just almost $500 billion in assets under management. And Eric, I want to welcome you here. Thank you for coming in today.
Yeah, great to be here. Absolutely.
So you do have a lot of money that you're managing.
We're happy to round up to 500. It depends on the day. But yeah, I would say it's a great client base, ultra high net worth, institutional, and also mass retail. So it's we see a lot of slices of life, and it's certainly fun to work with that many different client types.
Okay, so this is, did you hear, he said like the ultra rich people, that's who he's dealing with. Let's see where they're putting their money. Are they putting it just in cash, in savings accounts or CDs like a lot of us think we should do? Or are there other investment strategies? They don't really go into real estate. They talk about the equities, different investment options. So we'll go through this, but also at the end of this video, I want you guys to understand how inflation works. I tried to explain this several times, but they do have a good analogy on how it works throughout here. So let's get to it.
What's the biggest concern you hear from your clients at this point?
Number one is inflation. I think that people are consistently saying, look, this is an environment where, as we kind of look at the sort of tail end of this year and into the start of next year, will we be able to sustain interest rates really below that magical 5% number? That's for the 10-year Treasury. Seems to be where the good...
Okay. 5% on the 10-year Treasury. So if we go over to, where is it? It's on here somewhere. We have the 5-year Treasury on the board somewhere, but it'll most likely be showing down through the bottom through here as we go through it, or here, or they might even show it on the screen. We want to make sure the 10-year Treasury doesn't get the 5%. So that's the trigger point. And then he also says that's also when the bond vigilantes start to jump in. So let's let him explain all this to you.
Good things happen for capital markets. So we think that, again, still that risk-on perspective across a lot of different asset classes works. Inflation that pushes above, that 2.5% to 3% sustained level, that could be the elevated level, if you will. It keeps the interest rate bond vigilantes really still in play, and that push towards 5% could be more of a challenge for markets.
If your clients are worried about inflation, then they have to be worried about outpacing that inflation in their investments. What do you tell them?
Yeah, Becky, it's one of those things where it's been stubborn to get people out of cash. When you've had this almost nostalgic view of cash above 4.5%, that's sort of been a level that people have really anchored on, if you will. So we've been emphasizing a variety of different things. Again, everything from dividend-paying stocks to international equities, also a lot of private assets, which we think makes sense. But even things that aren't so expensive, they don't necessarily roll off the tongue. So things like structured credit, which does provide a pretty solid total yield that isn't just susceptible to interest rate risk. Those are things that we really entice people to move out of cash into more productive assets.
That's an interesting point, though. All this cash that's sitting there waiting on the sidelines, part of that is people have been waiting for a pullback that they haven't gotten.
Yeah, it's been the sort of, the waiting for Godot, and Godot never shows up. And I think that, there are a couple of catalysts out there. Again, there's CPI data. We're in this lull period where we don't have a lot of corporate earnings. We're sort of waiting for more concrete policies from the new administration. So there may be some opportunities, some pockets to pick up. Clearly, in anything that hasn't been dollar related, you've had lots of pullbacks. So the things that really haven't worked include, international equities, especially the European side. So for those that are looking for more of a valuation play, that's starting to become more interesting, but probably a little brave to step in before a lot of tariff releases emerge.
And that's what people say. Look, we have run so far over the last couple of years. The markets are up substantially. The PE ratio has gone up substantially on all of these things. And we're getting a lot of what you might anticipate coming from this new administration came from Election Day on. So you're seeing a front-end loading of some of these gains. And that's why people will say, maybe we want to be cautious, maybe we want to see what comes next. But if you also have all this cash that's been building up on the sidelines, I wonder if any slight pullback that begins, 2, 3, 4, 5%, gets washed out because that brings new money in too.
Yeah, I think it's a great thesis. I mean, this sort of way we've been playing it is like ex ante before the next wave of, we think, animal spirits and sort of more progressive policies come through. We've been overweight global equities, especially U.S. There's another leg to that trade, we think. But again, nothing solves high prices like high prices, and I think that enticement of getting people in, such a continued inflow, I should say, of assets into equities, particularly U.S. equities, that train just continues to roll. So we think there's still an opportunity to again, be aggressive, but there's probably another leg that has to be proved with a little more policy certainty. That's probably a good thing for us to focus in on.
And we started this conversation with you saying inflation is the biggest concern. Maybe that's the thing outside of geopolitical things that we...
Here's when they start talking about inflation and how it really, really affects you and I's pocketbook. It's kind of intriguing. Like I said, I tried to bring this up one other time, but my brain just wasn't functioning at that point. So they have a good analogy on how this inflation truly works. So let's bring it back.
We can't control, don't know anything about. But if inflation were to rise again and be stronger than anticipated, and the Fed either had to stop cutting rates or start hiking rates as a result, maybe that's the game changer.
Yeah, agreed. That would be the sort of push, if you will. We haven't had interest rates in this country above 5% in 17 years. We had one day last year for like literally a millisecond. And since then, we've obviously had some rate increases, and we've obviously had a bit of a pause from the Fed. But that move below 5%, which precedes a great financial crisis, that's really has been at least correlated with higher asset prices. So that's a test the markets don't want to see. We think we're in good shape if we stay below that 5%.
We used to do fine at 7 and 8% for years, and companies deployed cash and took risks, and things were allocated. It was fine, but it seems like those are a bygone era. And then I was just thinking about inflation and just how debilitating it really is. So it goes up 20% in 1 year, and you're like, oh my God, I can't afford any of this stuff. Then the next year it goes up another 3 on top of the 20. Then the next year it goes up another 3 on top of the 23. Then the next year it goes up another 3 on top of that 23. So now you're at 20. Nothing's solved.
That's right.
The rate of increase, has moderated, but you're still buying the things that you couldn't afford when it was up 20. And they're up 26.
That's right.
What it would take for deflation?
Well, I don't want deflation. I know, but we're in this. It's things that you're still scanning those things, and you get done, and you're still like, holy crap! What things are different. Things cost a lot.
And it's
more.
also so unevenly distributed too. If you think about the impact on the balance sheet of a lower-income consumer, I mean, it is.
Think about that.
Yeah, it is both in terms of shelter costs as well as food, transportation. That's 60-70% of the
take home or whatever it is, and you go to the supermarket. And really, you spend $250, even when you're scrimping for a family of 4.
Yeah.
And you're like, wow, what do I have left?
It's a big number. Yeah, and it's persistent. Absolutely. Absolutely.
I get it. I'm a dad too. I go to Costco on the weekends, and I'm thrilled if I can get out of there with a $300 bill or less. So that's what we're seeing right through there. So they do talk about the kind of the haves and the have-nots, how a lot of people have the investment savvy and the vehicles to put their assets in, where a lot of just common folks like me and you, we don't have the strategies like this guy has with the wealth advisors. So let's get over to it. Here's what the equities are doing right now. Dow Jones is down just a tad, S&P up just a tad, NASDAQ up a tad. So right across the board, there's really no major moves here. I think everybody's going to just hold off right now. A lot of the equity traders, and especially the bond market's going to hold off to see what the CPI number comes in tomorrow, because it is that important of a figure. So let's get over now to where are rates. So now these are where the top 6 rates that people use when they're buying their first house. So how do you figure out if you can get these rates or not? Well, just reach out to me. I would love to help you navigate. If you're out there trying to buy that first house, maybe trying to buy that first investment property, looking to refinance, you're an investor. You need cash. You need like bank statement programs, DSCR programs, things like that. I would love to help you. So I'll give you all my information at the end of this video, but without further ado, let's just finish up with our talks. Right through here, the Federal Reserve is meeting in 8 days, folks, 8 days. And what are they expected to do? Well, there's an 86% chance that they're going to cut rates at this next meeting. And then from there, basically all the bets are off. Basically, nobody knows at this point what's going to happen after that point. I don't care what everybody tells you. If you go through here, the probabilities or the aggregates, you can go down through here. At the next meeting, well, they're going to cut 0.25% at one of these next meetings, either in December and January. And then from there, I honestly say that I don't think the markets really know. They're going to be completely data dependent on all of this. That's not a comforting level for you guys out there if you're looking to buy that first house, but we would love to help you navigate this environment right now. So if you're out there trying to buy that first house, like I said, maybe looking to refinance or whatever, please visit me at therateupdate.com. Here's my website. There's a whole bunch of tools up there. We're starting to clean some things out up here. But if you're looking to put in your application to see if you could qualify for a loan at this time, click the Apply Now button. If you're looking to see if there's any assistance out there for you, please, instead of calling us, just schedule a one-on-one appointment. Love to talk to you in these. Otherwise, if you're out there and just say, Dan, I need some help, well, scroll down. We have one other tool that we just added right through here. If you're looking to refinance at some point, now not today, but at some point, let's say you're at 7.5 and you're like, hey, Dan, if rates get to 6.5 or 6%, I'd love to refinance. Can you reach out to me and let me know? Absolutely. We'll just click right through here. You can do that as well. It's just this little house right through here. It says Rate Watch. You can check that out, or you can scroll all the way to the bottom of our website and you're going to find our 800 number right through here. So our 800 number is 844-775-5626, or you can reach me personally at dan@therateupdate.com. So thanks so much for watching, folks. God bless. Have a fantastic afternoon. Can't wait to see you here at the closing bell to let you guys know how all this mess ends for the day. Thanks for watching. See you later.